The U.S. housing market is not bending anymore. It's breaking. And it's breaking in ways most Americans feel every single day, but can't fully explain. Whether you're someone trying to buy your first home, relocate for better opportunities, escape rising rents, or simply understand why shelter has become the hardest basic need to secure, you're living inside a system that stopped functioning like a normal market years ago. But what you're seeing on the surface, the high prices, the bidding wars, the low inventory, the sudden spikes in rent, those are just symptoms. The real story sits underneath, buried in decades of decisions, mistakes, policy failures, financial incentives, demographic shifts, and economic pressures that rarely get explained clearly. This video is about that deeper story, the story the headlines don't talk about, the story politicians avoid, and the story most media outlets oversimplify. Because the truth is uncomfortable, America is not experiencing a temporary housing problem. It is living inside a long-term, structural housing crisis that cannot be solved quickly, and in some places, may not be solvable at all. So today, we're going to break this down, step by step, in a way that's clear and grounded in reality. No hype, no fear-mongering, no magical predictions, just the data and the dynamics shaping the new American housing landscape. Let's start with the idea of affordability, a word that gets used constantly, but almost never explained honestly. Housing in America has drifted so far from affordability that the traditional path of education, job, and homeownership has practically collapsed. For decades, economists used a simple benchmark to understand the balance between income and home prices. A home priced at roughly 3 times the average household income was considered manageable, normal, and healthy. But in many parts of America today, that ratio is not 3 to 1. It's 5 to 1, 6 to 1, sometimes even higher. In cities like Los Angeles, Denver, Miami, Austin, Boston, Seattle, and even mid-sized metros that used to be considered affordable, the gap has widened to a level that would have been unthinkable 20 years ago. And this isn't happening in one region. It's a national phenomenon with local extremes. But affordability isn't just about price. It's also about the cost of borrowing. The average American who attempted to buy a home during the pandemic faced historically low interest rates. But the average American trying to buy a home today faces mortgage rates that have doubled, sometimes tripled, from what buyers got just a few years ago. Add to that the fact that wages haven't kept up with the cost of living for nearly 2 decades, and you get a perfect storm. High prices, high rates, and incomes that simply haven't moved with inflation. That combination has pushed millions of Americans into a new reality. A reality where homeownership is no longer a milestone of adulthood, but a luxury class asset that feels almost unreachable. To understand how we reached this point, we need to go back long before the pandemic. Because this crisis didn't start in 2020. It started decades earlier, when America slowly, quietly stopped building enough homes for the people who needed them. One of the most ignored truths about the American housing market is that the country has been underbuilding for a very long time. Depending on how you measure the gap, the U.S. is short somewhere between 4 and 7 million homes. That's not a minor shortage. It's a national deficit so large that even if construction doubled overnight, it would take years just to catch up. The simple question is why? Why did the country build so little for so long? The honest answer is layered. Some of it comes from zoning rules that make it nearly impossible to build anything other than single-family homes in huge portions of the country. Entire neighborhoods, and in some cases entire cities, are locked behind rules that prevent the construction of duplexes, triplexes, or multifamily housing, even when demand is screaming for it. Some of it comes from local opposition. Communities that don't want more density, more traffic, or more renters push back against new construction. A large portion of America's housing policy is controlled not by federal agencies, but by local boards and councils where longtime homeowners hold enormous influence. Some of it comes from a workforce problem. After the 2008 housing crash, millions of construction workers left the industry, and a significant portion never returned. As a result, even as the country needs millions of new homes, there simply aren't enough skilled workers to build them at the pace required. And some of it comes from cost. The price of materials, lumber, concrete, steel, surged during the pandemic, and although those prices have cooled, they never returned to where they used to be. Add higher financing costs for developers, and many projects become too expensive to complete. When you add all of these factors together, you get one outcome. America built too little for too long, and now the shortage is so large that the system cannot self-correct. But even that doesn't fully explain the sudden spike in home prices after 2020. To understand that, we need to look at the shockwave that hit the housing market during the pandemic. The pandemic didn't create the housing crisis. It accelerated every weakness already built into the system. Overnight, millions of Americans found themselves working from home. And the moment geographic constraints disappeared, a massive national migration began. People left expensive states for cheaper ones. They left dense cities for suburban or rural areas. They left old metros in search of lower taxes, more space, and better quality of life. Cities like Boise, Austin, Tampa, Phoenix, Nashville, and Raleigh saw population surges so strong that local housing markets simply couldn't absorb the demand. At the same time, mortgage rates collapsed to record lows. Money became cheap, credit flowed easily, and buyers rushed into the market because everyone understood the same thing. If you didn't buy now, someone else would. Investors entered the market aggressively too. Large firms, private equity funds, and corporate landlords buying single-family homes in bulk. In some cities, as many as 1 in 5 homes went to investors, pushing regular buyers to the sidelines. And then something even more unusual happened. Millions of homeowners locked in ultra-low interest rates, mortgages under 4%, sometimes even under 3%. Those homeowners have almost no incentive to sell because buying a new home today means paying twice the interest on the same loan amount. That created a frozen market. Almost no one wants to sell, but millions want to buy. And that is where the system truly breaks. When a market freezes like this, it doesn't collapse in the dramatic way people imagine. No sudden crash, no wave of cheap homes, no dramatic drop in prices. Instead, it becomes something more complicated and more difficult to escape. Prices stay high because there simply aren't enough homes available. Buyers get frustrated and wait for a moment that never seems to come. Sellers stay put because moving makes no financial sense. And what you get is a gridlocked system where everyone is stuck. This lock-in effect has become one of the most powerful forces shaping the modern housing market, and most people underestimate how deep it runs. When tens of millions of homeowners are financially disincentivized from selling, the market simply cannot reset. You can't magically create supply if the people holding that supply have no reason to move. But this brings us to one of the most misunderstood parts of the entire conversation: the idea that this market is in a bubble. That word gets thrown around constantly. Headlines, social media, even everyday conversations rely on that term. But the reality is more nuanced. The US is not in a traditional bubble in the same sense as 2006 or 2007. Back then, the market was built on bad loans, speculative buying, low credit checks, and inflated risk. Today's market is built on a shortage of supply and a generation of homeowners holding some of the safest, lowest-rate mortgages ever issued. That difference matters. A bubble pops when supply overwhelms demand. But in today's market, supply is so limited that even a pullback in demand doesn't create meaningful price relief. This doesn't mean prices can't fall. They absolutely can, and in certain markets they already have, but the mechanics are different. Prices don't fall because tens of thousands of people panic sell. They fall because buyers retreat, affordability disappears, and overvalued markets stop being able to justify their price tags. The challenge is that most Americans don't experience the housing market as a clean national story. They experience it locally, and local stories vary dramatically. In some cities, prices are softening. In others, they're still rising. Some places are seeing bidding wars and low inventory. Others are starting to see price reductions and longer listings. The US doesn't have one housing market. It has more than 100 of them, each moving on its own timeline, shaped by local economies, migration patterns, job markets, taxes, regulations, and population shifts. But even with all those differences, there is one consistent trend across the entire country. Housing is no longer responding to the traditional rules of supply, demand, and affordability. It's responding to deeper structural issues that most Americans never see. One of those issues is the generational divide. For decades, the housing market followed a predictable rhythm. Young adults rented, built savings, formed families, and transitioned into homeownership. But that transition is breaking down. Many young adults today are renting not because they want to, but because buying is mathematically impossible. Meanwhile, older generations, especially baby boomers, are holding on to homes longer than any generation before them. They're living longer, they're healthier, and many plan to age in place. That means homes that once would have returned to the market every 20 or 30 years are now staying locked up for much longer. This contributes to the tight supply, but it also shifts the entire balance of power. Older homeowners hold a disproportionate share of America's housing wealth, while younger Americans Americans face a steeper mountain than any generation in modern history. When you combine that generational gap with rising costs, stagnant wages, and soaring rents, you get a population that feels increasingly disconnected from the idea of homeownership. This disconnect isn't just emotional, it has long-term consequences. When young adults delay homeownership, they also delay wealth building, family formation, and long-term financial stability. The American economy was built around the assumption that each generation would climb the same ladder the last one climbed. But that ladder is now tilted, uneven, and in some places, missing entire steps. Another force shaping the market is migration, the quiet reshuffling of the American population. Over the last few years, millions of people have moved out of expensive coastal states and into the South, the Mountain West, and parts of the Midwest. States like Florida, Texas, Tennessee, Arizona, Idaho, and the Carolinas have absorbed massive population inflows. Meanwhile, states like California, New York, Illinois, and parts of the Northeast have seen consistent population losses. When large groups of people leave one region and flood into another, the housing markets in both areas transform. Outbound markets often see slower demand, rising inventory, and eventually softening prices. Inbound markets see the opposite: limited supply, rising prices, overwhelmed infrastructure, and growing competition for rentals. This is why some of the biggest price spikes happen not in America's largest cities, but in mid-sized metros that were never designed to absorb sudden population booms. When a city expects to grow gradually and then suddenly receives years' worth of new residents in a short period, the housing system simply cannot keep up. And then there's rent. Rents surged during the pandemic in a way that shocked even seasoned analysts. In some cities, rents jumped 20 to 30% in a single year, a move almost unheard of in modern housing history. For millions of renters, this wasn't just a financial inconvenience. It was a breaking point. It pushed people into smaller apartments, forced relocations, reshaped personal budgets, and strained credit scores. Even today, despite some cooling, rents remain dramatically higher than they were 5 years ago. What makes rents especially dangerous is that they influence the entire housing ladder. When rents rise, it becomes harder to save for a down payment. When down payments become harder, fewer people move into homeownership. When fewer people buy, demand for rentals stays high. And when demand stays high, rents increase again. It becomes a loop with no obvious exit. But if you really want to understand why the U.S. housing market feels broken, you have to look at a factor almost no one talks about directly: expectations. For decades, Americans expected home prices to rise slowly and steadily. They expected to move up as their careers grew. They expected wages to keep pace with the cost of living. They expected housing to be an achievable goal if they worked hard and stayed disciplined. Today, those expectations no longer match reality. Housing has become a competition instead of a progression. It has become something people fight for, not something they eventually reach. And that shift, that psychological shift, might be the most revealing sign of how deep this crisis truly goes. Because when a society's expectations break, the market is already broken. If you zoom out far enough, the U.S. housing market starts to look less like a marketplace and more like a pressure system. A system where every small change compounds the next. Higher rates force people to stay put. People staying put reduce supply. Low supply keeps prices high. High prices push younger buyers into renting. High rents make it harder for them to save. Lack of savings prevents them from buying. And the entire system cycles back into the same gridlocked shape. But this pressure doesn't build evenly across the country. It builds in pockets, in waves, in regions that reflect broader national patterns. Some areas crumble under the weight of it. Others adapt, and a few places manage to absorb it entirely differently. That's why when people try to compare the current market to 2008, they miss the point. The crash in 2008 was a single national event with local consequences. What we're living through now isn't a crash. It's a structural transformation happening at different speeds across different regions, based on different constraints. For example, take the Sun Belt, a region that rewrote the U.S. population map over the last decade. Cities like Phoenix, Austin, Tampa, Jacksonville, Raleigh, Nashville, and Charlotte were once considered affordable alternatives to coastal metros. People moved there for lower taxes, warmer weather, bigger homes, and a better quality of life. But as millions poured into these regions, their housing markets flipped almost overnight. Prices surged faster than local incomes, rents exploded, commutes lengthened, and the exact thing people moved to escape, unaffordability, began to appear right in front of them. Meanwhile, On the opposite side of the country, states like California, Illinois, and New York saw hundreds of thousands of residents leaving. But even with outbound migration, these states didn't magically become affordable. Their structural problems remained: high land costs, restrictive zoning, slow construction approval processes, and decades of underbuilding. The exodus didn't solve the housing shortage. It simply redistributed pressure across the national map. And while all this was happening, another story was unfolding, one that rarely gets the attention it deserves. In many small towns and rural areas, the housing crisis looks completely different. Prices may not be skyrocketing there, but supply is still tight. Not because demand is booming, but because builders don't want to build in markets where population growth is stagnant or declining. Developers target places where demand is guaranteed, and that leaves aging housing stock, limited rental options, and little new construction in the towns that arguably need investment the most. This uneven landscape creates a strange paradox. Some Americans live in places where housing is expensive because too many people want to live there. Others live in places where housing is stagnant because too few people want to live there. And neither scenario leads to a healthy, stable, accessible housing market. But if you want to understand the deepest cracks forming beneath the surface, you have to look at the financial system that underpins this entire market. Specifically, the mortgage structure that defines how Americans borrow, repay, and build equity. The 30-year fixed-rate mortgage is a unique feature of the U.S. housing system. Most countries don't offer it. It's stable, predictable, and generally consumer-friendly. But when interest rates fall too low for too long, the long-term contracts embedded in these loans end up locking people into decades of artificially cheap debt. That's exactly what happened during the pandemic. Millions of homeowners refinanced or bought at historically low rates, and those mortgages created an entire class of Americans who now have a long-term financial advantage. Cheap shelter in a market where everything else is expensive. But that financial advantage has a side effect. It freezes mobility. People don't move unless they absolutely have to. And that means fewer homes re-enter the market, fewer transactions happen, and fewer opportunities arise for new buyers. This rate lock phenomenon could last longer than people think, possibly years, possibly an entire decade. As long as mortgage rates remain elevated, homeowners with ultra-low rates will stay anchored. And the longer they stay anchored, the more the market slows down, tightens, and slips into this unnatural gridlock. This gridlock also affects something else: the psychology of buying. For the first time in a long time, buying a home doesn't feel like a step forward. It feels like a risk. It feels like something that could trap you in the wrong market, the wrong job, or the wrong city. When people think twice before they buy, markets lose momentum. When markets lose momentum, prices don't crash. They stagnate or drift or slowly deflate. And that slow movement is often harder to navigate than a fast one. Now, let's talk about investors, because their role in the modern housing market is bigger, more complex, and more misunderstood than most people realize. During the pandemic, institutional investors bought tens of thousands of single-family homes across the country, not because they wanted to flip them, but because they wanted to rent them. They looked at housing not as shelter, but as an income-producing asset, predictable, long-term, and resistant to economic shifts. The reality is that investors didn't break the housing market, but they did accelerate trends that were already pushing the market in the wrong direction. By competing directly with regular buyers, especially first-time buyers, they tightened supply at the exact moment demand was exploding. And once investors enter a market in large numbers, they don't leave quickly. Their decisions are based on long-term financial models, not short-term frustration. They hold, they wait, they stabilize their returns. Meanwhile, regular Americans are left navigating a landscape where they aren't just competing with each other. They're competing with organizations that can outbid them, outfinance them, and outweight them. But the most important part of this story isn't investors, or migration, or even the pandemic shock. The most important part is what's coming next, because the forces shaping today's housing market are not going away. They're compounding, and the longer they compound, the more dramatic the long-term consequences become. The U.S. is entering a period where housing is no longer just an economic issue. It's a social issue, a demographic issue, a generational issue, a geographic issue, and increasingly, a political issue. It affects where people live, where they work, whether they have children, how they plan their futures, and how much stability they can build. Housing was once a foundation. Now it's a barrier. And that shift carries consequences far beyond prices and mortgages. The question is not whether the housing market will return to normal. The question is whether the old idea of normal still exists at all. And that's the part almost no one wants to talk about. As we continue to look ahead, one thing becomes clear. The traditional engines that used to stabilize the housing market simply aren't working anymore. For decades, housing cycles were predictable. Prices rose, fell, corrected, and rose again. But the market we're living through now refuses to follow those patterns. It's being shaped by forces that are structural, not cyclical. And structural forces don't disappear when interest rates change or when the economy slows down. They embed themselves deeper and reshape the entire system over time. One of the biggest structural realities is population behavior. America is aging. The baby boomer generation holds an enormous share of the country's housing wealth, and they are aging in place. Technology, health improvements, and lifestyle changes have made it easier for older Americans to stay in their homes longer than any previous generation. And the longer they stay, the fewer homes become available for younger families. This creates a generational bottleneck. Younger Americans are not just competing with each other for limited supply. Many are competing with a system that naturally favors the older generation. Not because older Americans are intentionally blocking them, but because the demographic timeline of the country has changed. People live longer, remain independent longer, and hold on to their properties longer. This delays the transfer of homes from one generation to the next. Meanwhile, younger Americans face an environment where saving for a down payment takes significantly longer than it did for previous generations. Rising rents, student debt, childcare costs, and stagnant wages have made financial mobility harder. So even as boomers stay in their homes, many millennials and Gen Z adults remain renters far longer than they ever planned. This shift has huge implications. When homeownership declines among young adults, the economy changes. Household formation slows down. Families delay having children. Spending patterns shift. Entire industries, from furniture to home improvement to local services, feel the ripple effects. Housing isn't just about shelter. It's connected to almost every part of the broader economic ecosystem. And these economic ripples become even stronger when we look at the divide between urban and suburban housing markets. Urban centers were once the engines of population growth and economic opportunity. But the pandemic changed that dynamic. Remote work broke the link between employment and location. Suddenly, people no longer had to live near their office. They didn't need to pay high urban rents for the convenience of proximity. And that change drove millions towards suburban and exurban areas, places where homes were larger, neighborhoods quieter, and prices more reasonable. But the wave of new residents overwhelmed these areas. Builders couldn't keep up. Infrastructure couldn't expand fast enough. Demand soared, supply lagged, and suburban home prices surged to levels that would have been unimaginable just a few years earlier. Ironically, many of the people who fled cities for affordability ended up recreating the same affordability problems in the places they moved to. Urban areas didn't collapse, though. They transformed. Many large cities saw people leave temporarily, only to watch new groups move in or return later. But the nature of those cities changed. Office vacancies climbed. Commercial real estate struggled. Some neighborhoods lost momentum, while others adapted. This uneven reshaping of urban America will continue for years, and housing markets in major cities will evolve in unpredictable ways as hybrid work, office downsizing, and changing preferences continue to play out. But no matter where people move, to cities, suburbs, or smaller towns, the same underlying issue remains. The cost of building homes is too high, and the speed of building them is too slow. Even in booming areas, developers face challenges that didn't exist decades ago. Land is more expensive, permitting takes longer, local regulations are stricter, financing is more volatile, materials are pricier, labor is harder to find. Every step of the construction process now comes with friction. This friction is why so many markets built up enormous shortages long before the pandemic, and why the shortages exploded once the pandemic hit. It's also why so many people today feel like they're living in a market that simply doesn't make sense. And that feeling is not just emotional, it's logical, because we're living through a moment where the relationship between prices and fundamentals has broken down. In a healthy market, home prices reflect what people can reasonably afford to pay. But today, prices reflect scarcity, not affordability. They reflect competition, not income. They reflect constraints, not opportunity. That's why so many people look at the current market and ask, how are prices still this high? It feels counterintuitive. It feels irrational. But the reason is simple. Prices don't fall in markets where supply is permanently constrained. Prices don't fall when homeowners are locked into ultra-low rates. Prices don't fall when investors treat homes as long-term income assets. Prices don't fall when demand doesn't go away. It just gets delayed or redirected. But even if prices don't collapse, the strain on ordinary Americans grows. For millions, buying a home means committing to higher monthly payments than they've ever seen. For others, it means leaving the cities they love. For many, it means staying renters far longer than they expected. And for some, it means giving up on homeownership entirely. When enough people give up, society changes. Aspirations shift, priorities shift, expectations shift, and those shifts echo into politics, culture, and daily life. People begin to question long-standing assumptions about the American dream. They begin to question whether the system is designed to help them or hold them back. They wonder if homeownership, the single most important source of wealth building in America, is something they will ever experience. And that leads us to the most important question in this entire conversation. What happens to a country when one of its foundational pathways becomes inaccessible to a large part of its population? We are already beginning to see answers. More families are doubling up. More adults staying with parents longer. More people are moving to cheaper states. More people are delaying children. More people are relying on renting for decades. More people are feeling disconnected from the stability that homeownership once provided. These aren't temporary trends. These are deep societal changes, and they are happening because the housing market is no longer a gateway to stability. It's a barrier to it. The question now isn't whether things will go back to normal. The question is what the new normal will look like, and whether Americans are prepared for it. Because the next phase of this crisis isn't just about buying or renting. It's about what happens when a society begins to reshape around the absence of attainable housing. This is where the story becomes bigger than economics, bigger than interest rates, bigger than supply and demand. This is where the story becomes a national reckoning. When you start to think about the future of the U.S. housing market, the biggest mistake is assuming that a single event will fix everything. People wait for interest rates to drop. They wait for a recession to cool demand. They wait for construction to catch up. They wait for prices to collapse. But the uncomfortable truth is that none of these things alone can reset the system. Because the system is not broken at one point. It's broken in multiple places at once, and each fracture reinforces the next. Even if interest rates drop tomorrow, millions of homeowners with ultra-low mortgages still won't want to move. Even if developers ramp up construction, it won't undo decades of underbuilding. Even if certain overpriced markets cool off, others will heat up because America's population isn't stationary. It's constantly shifting in ways that make the housing landscape more unpredictable. The future of the U.S. housing market won't be a sudden crash or a dramatic correction. It will be a slow, uneven transformation where some regions stabilize, others struggle, and many adjust to a new reality where housing simply costs more relative to income than it once did. But to understand where we're headed, look at what's already happening beneath the surface. Younger Americans are redefining how they think about housing. Many don't see homeownership as the default goal anymore. They see it as something uncertain, something that might not fit into their life timeline, something that may not even be worth the financial risk if it locks them into the wrong city or the wrong job. This isn't laziness or lack of ambition. It's rational calculation based on the environment they've inherited. At the same time, older homeowners are becoming the anchors of the system. Their decision to stay in place, whether out of comfort, financial logic, or simply the desire to age where they are, reshapes the flow of housing across entire regions. For decades, the country relied on generational turnover, people moving, downsizing, relocating, and making space for younger families. But that flow has slowed, and slowing that flow tightens the market everywhere. Cities, too, are entering a phase of long-term reshaping. Some will recover their pre-pandemic energy. Others will transform, shrink, or evolve into different kinds of urban centers. A few may experience slow decline as commercial spaces remain empty, public services strain under shifting populations, and new economic realities push people towards smaller or cheaper metros. Meanwhile, the suburban boom isn't going away. Remote work isn't disappearing. The desire for space, privacy, and stability remains strong. But suburbs themselves will face challenges: rising prices, traffic congestion, stretched infrastructure, and the same affordability issues that once belonged only to large cities. The divide between desirable and undesirable markets will widen. Places with jobs, growth, strong economies, and warmer climates will continue to attract people. Places losing population will struggle to rebuild demand. Housing markets will become more polarized, more regionally distinct, and more dependent on economic momentum than ever before. And all of this leads to a simple conclusion. The U.S. is entering an era where the housing system will no longer operate as the equalizing force it once was. It will operate as a sorting force, separating people by income, geography, access, and opportunity. That's not a message people want to hear, but it's the message the data supports. However, it's important to say this clearly. This is not an unfixable crisis. It's a difficult one, but not unfixable. The biggest challenge is that fixing it requires long-term thinking in a country that often focuses only on short-term solutions. It requires building more homes, loosening restrictive zoning, increasing density where appropriate, improving renter protections, addressing labor shortages, and rethinking how we approach housing as a national priority. But none of those changes happen quickly. None of them reverse the pressure instantly. And none of them can undo the reality that millions of Americans today feel locked out of a system that once promised stability. For many families, the path forward will look different than it did for previous generations. It may involve moving to new states. It may involve choosing smaller homes, longer commutes, or shared living arrangements. It may involve renting longer, saving more deliberately, or reevaluating what kind of lifestyle is realistic. The American dream won't disappear, but it may evolve into something more flexible, more strategic, and more adapted to the world we now live in. For others, the future may involve more creativity, living in secondary markets, working remotely from lower-cost regions, or using new forms of financing that didn't exist years ago. Innovation will play a role. Demographic change will play a role. Economic cycles will continue to shape prices and opportunities. But the underlying truth is that housing stability will increasingly depend on adaptability. And that's the part of this story that matters most. Because the U.S. housing market is not just an economic system, it is a mirror. It reflects where people move, how they live, what they value, and what they fear. It reflects the strengths of the country and the weaknesses we often avoid acknowledging. It reflects the past that built the system and the future that will inherit it. When people say the housing market is broken, what they usually mean is that it no longer feels like it's working for them. But maybe the deeper truth is that the housing market is exposing the realities the country hasn't wanted to face. The slowing growth of incomes, the rising cost of living, the uneven distribution of opportunity, the demographic transformation of the nation, and the imbalance between what people need and what the system currently provides. And understanding this is not about being pessimistic. It's about being realistic, because clarity creates power. When people understand the forces that shape their lives, they make better decisions. They choose better paths. They adapt more effectively. And they stop waiting for an old version of the world to return. The U.S. housing market is not going back to what it was 10 or 20 years ago. But that doesn't mean it can't move towards something better, something more stable, more balanced, and more sustainable. The path to that future won't be short, and it won't be simple, but it will be built on the one thing that has always driven progress: understanding the truth, even when it's uncomfortable. And that's what this channel exists for: to cut through the noise, to make the complex clear, to show the reality that headlines overlook, and to help you see the world not as we wish it was, but as it actually is. Because understanding reality is the first step to navigating it.